All right, let's get into it. Just a quick heads up, this is purely for educational purposes. It is not financial advice. Every single investment carries risk, so you absolutely have to do your own research.
Okay, pay close attention. We are diving straight into the hard data today. What you're about to see is a quantitative breakdown of why this recent pop in Bitcoin, well, it isn't the bull run you think it is. We're looking at a very, very carefully constructed trap.
So right now, hit the like button, subscribe to the channel, and comment your top ticker below.
Look, I see it everywhere. Retail is absolutely FOMOing into this latest Bitcoin rally, chasing price, chasing the herd.
But you have to understand what's happening behind the curtain. Wall Street algorithms are using you as exit liquidity.
So, today, right now, we are going to expose exactly why smart money is dumping crypto right at this bear market resistance band and rotating massive amounts of capital into the physical energy grid.
Okay, first, we need to define the mechanism that's at play right here. This is a classic, textbook example of what we call an exit liquidity trap. So what is that? It's when a huge wave of new, emotionally driven investors floods the market. They provide all the buy-side volume that insiders and institutions need to cash out their positions at inflated prices. And the result? It's predictable, every single time. The new buyers are left holding the bag, stuck with devalued assets, while the smart money is long gone.
You know, this gets to the very heart of the issue. The great Benjamin Graham said it best. The investor's worst enemy is likely to be himself. And this is a lesson the market teaches over and over again. That fear of missing out, that FOMO, it's the exact psychological trigger that institutional algos are programmed to find and exploit.
So how can we be so sure this trap is being set right now? Well, we don't guess. We just follow the algorithmic footprints. They're left right on the chart for anyone who knows how to read them.
Okay, look at the screen. Look closely at this chart. We're on Bitcoin's weekly time frame. That is not random price action. That is a textbook rejection at a major macro resistance level. You see that long upper wick? That tells a story. It screams of significant selling pressure coming from institutions.
Now, here's where it gets really interesting. Look at the specific level. That rejection happened precisely at the 21-week exponential moving average, which is sitting around $78,400. This isn't some random line. For institutions, this is a key trend indicator. This is their line in the sand. And trust me, their algorithms are defending it with massive size. And to make matters worse, we have the true market mean, or TMM, right there at 78,200. Now, this metric is crucial because it gives us a more accurate cost basis by filtering out all the lost or dormant coins. So here's the bottom line. With price trading below the TMM, the average active participant in this market is officially underwater.
So how are they pulling this off? How are they executing these massive sells without tanking the market and causing a panic? The answer is dark pools. These are private off-exchange forums where institutions can dump enormous blocks of assets without signaling their intent to the public. It lets them get out without cratering the price.
All right, let's put it all together. Let me give you the plain English translation of what all this data means. It means Wall Street algorithms do not believe this is a new crypto bull market, period. They are mathematically front-running this resistance band, capturing the retail premium, and using that liquidity to buy physical assets, assets that actually generate yield during stagflation.
Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits.
Okay, so let's game this out. From this critical inflection point, there are really three primary scenarios we need to be prepared for.
First up, the bull scenario. It's a long shot. But if buyers can somehow absorb all this institutional selling pressure and close a weekly candle decisively above that 21-week EMA, it could flip that massive resistance into support. That would trigger a monster short squeeze. Next, the bear scenario, which frankly aligns with our core thesis. The rejection holds, macro liquidity continues to contract, and the bids just slowly drain away, leading to a bleed down to key support levels. And finally, you have the black swan. This is the big one. A sudden, harsh regulatory hammer comes down, specifically targeting stablecoins. If that happens, on-chain liquidity evaporates instantly, pulling the fuel from the engine and risking a full-on systemic crash.
And this brings us to the most important part of this whole breakdown, the great capital rotation. You have to ask, where is the smart money actually going?
I mean, think about it. If institutions are methodically offloading their crypto holdings into retail's hands, the billion-dollar question is, What are they buying instead?
And here's the answer. They're buying tangible, cash-flowing infrastructure. Specifically, the physical AI layer that powers the entire AI revolution. We are witnessing a massive secular rotation into the data centers, the power grids, and the compute infrastructure that underpins all of this next-generation tech.
And here's the real alpha, the inside track. Former Bitcoin miners are at the absolute center of this pivot. Why? Because they already have the single most valuable asset, massive, scalable, power-rich sites. They're now redeploying that infrastructure for AI and high-performance computing. In this new world, access to raw power is the strategic moat. So they're monetizing it, signing long-term contracts that completely de-risk their business from Bitcoin's volatility and literally transforms them into scalable compute utilities.
So, given this entire backdrop, how do you protect your capital? It's simple. You must operate with a disciplined, quantitative risk management protocol. No emotion, just rules. Here are the rules. Non-negotiable. First, every single trade must be bracketed with an OTO, a one triggers other order. This automatically sets your profit target and your stop loss the second your trade is filled. Second, your stop loss is never a random number. It has to be a 2.5 times ATR-based trailing stop. ATR is average true range, and this adapts your stop to the asset's real-time volatility. And third, the most important macro filter.
And this is the one rule to rule them all. Listen to me. Never, ever buy an asset that is trading below its 200-day moving average. This simple filter keeps you out of structurally bearish junk and stops you from trying to catch falling knives. Period. End of story.
The market is a game of probabilities, not certainties. If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below. I want to hear your specific thoughts on Bitcoin's resistance and this rotation into physical energy.